Yeah, for sure. And like you had kind of touched on the potential, I guess delay and some investment from people after like, this big event that is probably causing, some hesitancy to get involved in the space. Do you think also with regulators, you'll continue to just see the drum get beat now? I mean, like the Elizabeth Warrens of the world have to be like salivating over this event from a political standpoint. I mean, I saw this morning that Janet Yellen had come out and made some comments about the risks of stable coins, obviously talking about UST, but also had mentioned about this slight depeg that we saw in USDT, although that's happened numerous times throughout the years that it's existed. But I guess how do you think through the effects on what regulators are going to be doing based off of this event over the coming months and years?
I do think this will accelerate regulation because a lot of retail investors got hurt. I mean, they were told by people on YouTube to buy Luna and things like that. You even had a lot of content creators that themselves were like, they revealed they were 100% Luna, which is, they kind of like ate too much of their own cooking. And VCs are hurt, but then also VCs were selling these things to the public, marketing these to the public. So I think, regulators are going to go after some of the major exchanges. They do things like whenever there's like a spike in enthusiasm for a token, they fuel it. They start advertising for dog money or whatever the token of the day is. They kind of funnel retail into it right at the top. And a lot of these pass the Howey test, so they look like securities. They could be regulated as such. Outside of Bitcoin, it doesn't pass the Howey test, maybe a few others, right? There's a number of them that don't really pass it, but a lot of them do. And they kind of been in this gray zone where they don't do their initial coin offerings in the United States anymore, but the exchange is still marketed them once they're already sold to U.S. buyers. And so I think that that practice could get more scrutiny. And even I think a lot of people don't know the difference between different stable coins, right? So they see one stable coin blow up, an algorithmic stable coin, and then they use that to criticize the collateralized ones. But I also think over time we're going to see more regulation on what you can use as collateral for a collateralized stablecoin. And one way I would describe that is, if you look at so there's kind of two models you can go with. One is if you have as many assets as you have liabilities, so you're 1-to-1, then you better have all of your assets in risk-free investments because there's no margin of error there. If you lose any percentage of your investments, you're now no longer fully backed. So if you're roughly 1-to-1 backed, and you're supposed to be dollars, you should have the whole fund in dollars and T-bills, basically liquid dollar-based assets. Um, Now, the other option is to go like with a bank model. So banks, their assets are a variety of different risks. So they have things like cash and treasuries, but they also have things like loans and corporate bonds and things like that. But because of that risk, they have to have a capital buffer. They have to have more assets than they have liabilities so that even if they lose some of their assets, they can still meet their liabilities. And so some stable coins have operated in that weird zone where they're 1-to-1 backed, but or that at least that's what the accounting firms say, they're 1-to-1 backed, but then they're not 100% backed in risk-free capital. And so that kind of creates systemic risk. And we've seen over time stable coins have kind of shifted towards having a greater percentage of their assets in cash and T-bills, and many of them have gone 100% cash and T-bills. And I think that's kind of the trend where regulators are going to look unfavorably towards stable coins that have any degree of you know uh, risk in their asset books.
It seems like, with all the regulation coming about into the DeFi space, it's almost like a mirrored version of the current system in that sense of how centralized everything is and how much regulation is coming into the space. Do you think there's a possibility for DeFi to just become a completely mirrored version of, or, basically throwing lipstick on a pig of the current fiat system that we already have? I guess like how do you kind of look at the DeFi system as a whole, but moving forward, kind of the evolution of it in terms of how decentralized it could be, and do you think it will even exist in like 5 or 10 years from now? I think there's a lot of interesting stuff going on, but it's just a question of like, is it actually going to be decentralized, and is it just going to end up as a basically a new version of the same thing we already have going, if that makes sense?
So Chainalysis did some analysis a while back and showed that the vast majority of DeFi volume is like institutional and large whales. right? So it's kind of a mirror of the existing system almost. And I don't view any of it as kind of being over the event horizon in terms of how decentralized it is. Uh, to some extent, decentralization is a spectrum, but at the end of the day, if regulators really go after you, you're either decentralized and can withstand a regulatory attack, or you can't. And I think the vast majority of it is not over that critical threshold, and so they're all prone to being regulated, which kind of puts them in the same sort of situation, uh, as we see with the existing system. And so I do think that there's interesting code being developed. There's interesting use cases out there. I think decentralized liquidity is useful. Decentralized exchanges are useful. I think a problem is that like when they started inventing the car, for example, they would put like reins on it because people just kind of had this old way of thinking, right? And it's like you want to you want to have like aspects of the prior system, like horses, in your new system. Just you don't like change everything at once. And I think a lot of the concept we're seeing now around like leveraging hypothecation, yields that are not really yields, a lot of that is kind of like reins on a car. It's like an old way of thinking about it. And I think that the way I keep coming back to, I think Bitcoin's innovation. Most other things are kind of like fleas riding on its coattails. I do think collateralized stablecoins are an innovation. They basically took some of that technology, and so for example, if you are in Lebanon or Argentina, things like USDC or USDT can actually be perceived as being safer than storing dollars in your bank or your local currency, because in those countries, obviously, holding local currency is very risky, and if they hold dollars in the bank, they get confiscated. That's happened a number of times in a lot of these countries, and so ironically, holding this dollar pegged asset from a foreign entity is in many cases rightly perceived as safer, and it has less volatility than Bitcoin, for people that you can't have volatility over a 3 to 6 month period for their income and their short-term savings and their spending. And so, outside of Bitcoin and well collateralized stable coins, I think a lot of what we're seeing elsewhere is malinvestment, even though I think some of it eventually can make its way onto future platforms.
For sure. I want to pivot over to price action, and I made a post on Twitter, and I said, "What do you want me to ask Lyn?" And I would say 30 to 40% of the questions were just when bottom. So I'm not going to ask you that, but I will ask you, what are some of the areas, either from just a pure price action standpoint, maybe it's moving averages or on chain price levels, like what are some of the areas that you find really attractive and would say are deep value for BTC as we kind of move into the mid to upper 20K areas?
I think this mid 20 area is super deep value, right? So when you look at things like dormancy flow, or like just a bunch of different on-chain indicators are kind of deep value. Now, at the end of the day, you can have these wicks that go well below that if there's kind of like liquidity crises. But overall, I think we're kind of in that range where I don't know exactly where the bottom is going to be. Obviously, I think you're in the phase where if you're dollar cost averaging or you're layering in purchases, I think this is a good place to do it. I think trying to catch some sort of like micro bottom is kind of a fool's game. Uh, some things I'm watching, for example, I was watching the tether peg because it's kind of a sign of liquidity, right? If that peg is struggling, in addition to whatever concerns people might have about the quality of the collateral, it's a liquidity sign, right? So liquidity is being sucked out of the space so fast, so it's hard for anything to rally. And when you start to see that kind of recover to the extent that it recovers, that's kind of a sign that maybe the worst is behind us, and some projects will continue to bleed out, but maybe the highest quality things like Bitcoin, they might already have their capitulation in. And so it's hard to say for sure, but I think that anywhere in with a two handle, you're basically getting into kind of deep value range, and then it just comes down to managing your own risk bucket, right? So a lot of people think they can withstand volatility, and then when it actually happens, they realize they can't. And so I think it's important to have the position size that makes sense to you, so that you can have, unless you're an active trader, so that you can have a 3 to 5 year, position, and let that play out, according to your thesis or not.